We think looking at the big cycles here can be very informative. And we think we're at a juncture right now where thinking about these type of longer term cycles is going to be very, very beneficial. Seas are flat, sun is shining, there's great people, everyone's good looking somehow, and this party is going in full flight. We've even got to a point now where this party is accelerated to a real bash, right? We had quality and growth being the only game in town. That was the place to be. If you didn't have quality and growth, particularly US companies, offshore, that you didn't have it. It wasn't where it was. I mean, a couple of years ago, I'm sure you all remember, we had Zoom. Great product, but I'm not sure it's worth more than Exxon. And yet that's what the market said. The market had the market cap of Zoom being more than Exxon in 2020. Okay, I think the weather is starting to gather. You've got some dark clouds on the horizon. I think some of the people on the boat are nervously eyeing life jackets. There's probably not enough life jackets. There's too many people on that boat and not enough alternatives. There's not enough lifeboats or life jackets. It's a Titanic situation, potentially. And I think this is a very, very important analogy about where we stand today. When we look at markets, we see immense crowding in what's worked in the last 10 years. That's very understandable. That's how human psychology works. That's how markets have always worked for hundreds of years. But there's a danger in that, is that those cycles don't last forever. And really interestingly, every decade there seems to be this theme that really draws these concepts together, these stocks together. In the 1980s, it was about peak oil. We were never going to have enough oil again. It's quite interesting. I mean, if we move back there again, that could be quite interesting. 1990s was actually very remarkable and very unique. Japan was going to take over the world. It's bizarre to think of now, but the top companies in the world in those days were Japanese companies. That, as you know, that bubble crashed spectacularly, and many of those companies have yet to recover, almost 30 years later. 2000s, I think there's a theme that actually feels very familiar. It's the TMT bubble. I think I won't go into that too much. I think a lot of analogies with what we've seen in the last 10 years. And then the 2020s, we had China and emerging markets and commodities and materials really taking over the world. And again, a bit of a revenge of the old economy stocks. And then finally, the last decade, only tech can deliver growth. Now, what's really interesting is that a couple of points here. One is there's always change. Change is the only constant, okay? And the other interesting thing is that bear markets always seem to mark the transition. There's always a bit of painful normalization that marks the transition from one regime or one capital cycle to the next. We think the cheaper stocks are still where the value is. And what this chart from AQR shows you is over a long period of time, they adjust for industry and countries, so it's a nice representation. They show you the gap between the most expensive parts of the market and the cheapest parts of the market. And 0 is that average gap, because there is always a gap, and it's healthy to have a gap. But what you see is every now and then you get these blow-offs. They often come after a cycle or a regime of a lot of speculative activity or euphoria. And as we've shown you, we think we've just come out of one. We think that's what the evidence shows. So what that means is that expensive companies are too expensive and cheap companies are too cheap. And there's an opportunity in that. And we saw that last year starting to unwind. So last year, some of the biggest pain that we felt in the markets was in the most speculative areas. The other very important point is that we think US assets look incredibly risky to us. The US has been the place to be. Warren Buffett's backyard. And it's had a hell of a run. But what you've seen now is it's outperformed the rest of the world equities by so much that the US on its own is almost 70% of the MSCI world. So the US, one country, is 70% of global markets. And what we see with history is that those levels of extreme concentration, while they happen from time to time, are never permanent. There's always a normalization. Very simply, we think it means that a new cycle has very likely commenced. We don't know for sure, it doesn't have a 100% probability attached to it, but we would argue it's got a very large probability. And it has radical implications on where risks and where opportunities will be in the years ahead in investment markets. So this is a snapshot of what we think this means. What you'll see is, on the one side, it'll be those areas that did incredibly well the last 10 years we think are very likely to disappoint. They're still very expensive. There's still a large degree of over-ownership. They're very crowded. Almost everybody's in them. And there's still a lot of speculative growth priced into their asset prices. And earnings, and as we saw in the capital cycle, is very, very extended. So we think those areas are likely to disappoint. And we think there are better opportunities at much lower risk with a lot more opportunity ahead of them.
Last year was probably one of the toughest years that we've had globally. Just looking at the performance of the MSCI World, it was actually down a little bit more in dollar terms, but this is the Rand performance. The Aussie was flat. Now, if you told me a year ago that the MSCI World would have been, one of the worst years on record, you probably would have think, geez, it's not a good idea being exposed to mid or small cap companies. But completely against the run of play, they were a very good source of alpha for our clients and our funds. A couple of examples there. We've got Grindrod Shipping, HCI, and the Grindrod, the conglomerate. On average, they were up more than 100% last year. And then just as a reminder, given our relative size to competitors, we are still able to access these opportunities in a meaningful way for our clients and our portfolios. So we're not arguing against a country-specific risk premium, but we do think it's quite excessive, just what we are observing today. There's no reason why the bond yields could be back at 9%. That still adequately reflects quite a bit of country-specific risks. And should we see those yields again in 1 year's time, you could easily get a return from the government bond market north of 20% for very low levels of risk. And then just quickly where it all comes together, this is our multi-asset funds. All our key core capabilities are represented in the multi-asset funds. And this is where me and Justin, our responsibilities sit in the PSG Balance Fund and the PSG Stable Fund. From a personal point of view, we're quite excited about the future, but we do take that with a huge dose of nobleness. We know the markets can surprise us most of the time, but we do look forward in the years ahead. So thanks, everyone. Thanks for attending today. We really appreciate it. Thanks for coming.